On It's the Economy today, we are discussing the most important number of the moment. The September US CPI inflation number came in at red hot 8.2% versus market expectation of 8.1%. The markets, however, sprung a surprise. After an initial decline, the Dow, S&P and the Nasdaq indices rebounded smartly to post record one-day gains. However, the CME Fed Watch tool, it's a tool which tells you what people are expecting the Fed to do. That indicated the market expects the Fed to hike by 75 in November. That's sealed, but also a good 61% expect a 75 basis hike in December as well. Earlier, the expectation was 50 basis. Now, what does this mean for the US, the world, and for emerging markets? I have with me Aditya Bhave, senior US and global economist at Bank of America Securities. And we are also connecting with Robert Carnell, head research and chief economist, Asia Pacific at ING Bank. Gentlemen, thank you very much. Robert, with your permission, I'm starting with Aditya because he has stayed up for us all the way from the United States. Aditya, before the inflation number analysis, can you explain why your market behaved the way it did, that huge rebound?
Thanks, Lata. It's my pleasure to be on. I think it's a combination of a few things. First off, there was some significant unwinding of positioning. And second, I think investors took a fairly optimistic view of the inflation number. So the interpretation there was that core goods inflation came in quite soft, while the strength in inflation was in core services, particularly shelter-related inflation, which is broadly expected to fall because there's a lag in the way in which it's measured.
Okay, so a certain certainty about inflation falling. But according to the CME Fed Watch tool that I referred to, the bets for a 75 basis hike in December has gone up very sharply, 61%, Aditya. So have you changed? Are you also expecting 75 in December?
That's right. So our base case was already a 75 basis point hike in November. We stick with that. For December, we're sticking with 50 at the moment, although obviously we acknowledge that with this inflation print, the risks of a 75 basis point hike in December as well have also increased. The caution that I would add on that is that we are going to get two more inflation prints and two more jobs reports before the December Fed meeting. So there is, significant room for the data to move before that meeting actually happens.
Oh, yes, there is that. I agree with you. On that note, Robert Carnell, welcome to this chat. What is your expectation now? Are you also penciling in more rate hikes from the Fed?
Well, I think like Aditya, you have to wait and see where the data goes from here. Last night's data was unhelpful from the point of view of wanting to see, perhaps an end to the Fed tightening. That's clearly still quite a way off. And of course, we've got retail sales coming out tonight as well. And the data becomes very, very complicated now where you're looking for bad news really to be good news. And, in spite of what Aditya said about the sort of split in the service makeup, it is quite remarkable that the equity market looked at numbers which, on the face of it, basically said rates are going to go up faster, go higher, and stay higher longer, and then decided to rally on it. It's not entirely sensible, even if you're doing some moving, getting rid of some positions. You have to look at this and think this isn't going to last very long. This looks like a very temporary adjustment in policies, and you've got to really think that the bond market usually gets it right more than the equity market.
Oh, yes. On that note, let me get the growth macro changes from Aditya. Aditya, have you changed any of your macro forecasts, like US or global growth numbers?
If the Fed went 75 in December, we would become more concerned about weaker growth. So recently, we increased our terminal rate forecast by about 50 basis points to nearly 5%. And when we did that, we penciled in a slightly deeper recession than we already had in our forecasts. So more rate hikes beyond that, if we were to add those into our forecast, then most certainly we would become concerned about a deeper recession still.
Robert, a similar question to you. now with perhaps a new fait accompli, I mean, I agree with you, you haven't called it a fait accompli yet. There are many numbers from now to December and thereafter as well. But is a 5% peak rate a fait accompli for you? And if it is, are you more worried about any of the macros like EM growth?
No, it's not a fait accompli. The market's got almost 5% priced in by May next year, but a lot can happen between now and then. There's actually a lot of the inflation number that should start dropping out fairly quickly once we get into 2023. I mean, base effects are doing an awful lot of the heavy lifting at the moment. Clearly, there is some genuine underlying inflation that needs to be squeezed out of the economy as well. And then we get this sort of difficult dynamic between the macro side and what the Fed has to do, because we do actually need to see the macroeconomy, the US economy slowing down to get these inflation numbers down towards, probably not at, but towards their target range. So, every time you see a piece of good data, it's not really very helpful. We actually do need to see these numbers coming off.
You're not at the moment reducing your growth forecast for any of the Asian economies, Robert?
Yeah, we've been trimming them, throughout much of the year as inflation has stayed and been stickier than was originally expected, as local central banks have increased interest rates. I mean, the inflation numbers themselves weigh on consumer spending and reduce real spending power. So, there's been a constant kind of trimming. Perhaps we've been sort of following rather than leading, but it's definitely been on a downward trajectory through most of the year.
Okay. Just before I carry on with the macros, Aditya, a too fast, too sharp rise in rates has caused a near accident in the United Kingdom. Do you think we could see something like that in the non-bank, in the shadow of financial space in the US and in other countries?
It's a risk, but I think it's a relatively low risk for a couple of reasons. The first is that the US is in a different position from the UK, right? The dollar is the world's reserve currency, and the dollar has actually been appreciating in this risk-off trade. And to the extent that US yields increased for some reason, let's say some kind of liquidity event, there would be significant demand from global buyers, right, which would support the US Treasury market. The other thing to keep in mind is that at the end of the day, the Fed can step in quite quickly and address any instability problems, in our view. I don't think there's any reason they couldn't do that while hiking rates. Yes, one view is that that would entail hiking and easing at the same time. But I think they can make that clear distinction that any intervention in the bond market, if needed, was, clearly related to financial instability or, financial stress rather than trying to ease financial conditions.
All right. I don't know whether we can be that sanguine about institutions outside the US. Robert Carnell, before I come to institutions, today, of course, the dollar index has moved down a bit from that 113 levels. But do you see further depreciation in currencies like the rupee and other Asian EM currencies?
Certainly for a while. I think the strength of Fed tightening in the short term is going to be the dominant factor. Yes, we get odd market moves like last night, and currencies seem to follow the equity market rather than following the rates market. I think that's not a sustainable direction. Still at the moment we've got Fed policy which is widening interest rate differentials against most of the rest of the world, and you've got a generalized risk-off sentiment as well, which tends to feed into dollar strength as well. Now, I think there will come a point where that flips, and everybody's looking for this pivot, and we might see that before the end of the year. But in the short term, I think dollar appreciation is the way we see things. But we could be swinging around, close to the year end, perhaps even a little bit before that.
Any thoughts specifically on India, Robert? Do you think that the rupee could get even weaker? It went all the way up to 83 almost, and then has pulled back rather smartly. You see more depreciation. Do you think more rate hikes will be called upon from the Reserve Bank? Have you trimmed India's growth macros?
Yeah, we have trimmed the growth outlook a little bit. I mean, we had a 7% figure until a couple of months back, and we're down into the sort of mid-sixes now. for the year, and
For this year or for next?
That's going to be the sort of range that we're looking for next year as well. But actually, the outlook for Indian inflation will probably start to look a lot better over the next couple of months, and that should take some pressure off the RBI. I don't think they're quite finished with their tightening. I think we'll get another 25 basis points from them in December, maybe even a slightly bigger one. But I think that inflationary push that's been driving them forward is going to start easing quite significantly over the next couple of months, and will enable them to, at the very least, slow, and possibly through the early part to the middle of next year, we might see some trimming of the hikes that we've seen already.
So the growth trimming that you are speaking about in India, mid-sixes, is for both FY23 and 24? And is that because the globe is slowing?
Yeah, it's because the globe is slowing. It's because inflation is high, which weighs on people's spending power. It's because rates have gone up, which will weigh on investment. You add all the factors up at the moment, and you've got a pretty toxic global environment.
Yep. All right. We've run out of time, though I wanted to discuss the institutional fabric as well. Thank you very much, Robert and Aditya, for joining us. Well, the verdict is a little more slowness for India and for Asia as, inflation continues to remain high and the world goes into, a tighter financial syndrome. Nothing that we didn't know, just more of the same. And that's why the market perhaps has shrugged it off for the moment. We leave the markets in pretty fine shape. Chartmasters will take the action forward.
Brought to you by